Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. To us, 2009 marked the beginning of a secular bull run in the stock market. Now, within this bull run that we've had over the past 13 years, we've had multiple corrections that have exceeded 15%, and a few of them actually dipping into bear market territory. According to CNBC, a bear market is triggered when you see the SP500 go below 20% off its recent high. This actually occurred 3 times during this period. Once in 2011, once in 2018, and once, of course, during the pandemic. And here we are again, 24% off the all-time high. Is this the end of the secular bull run we've been in since 2009? Or is this just another short-term bear market scare? That is the big question that everyone's asking, and this is what we talk about multiple times a week on this channel. If you are interested in following these crazy markets with us, make sure to smash that subscribe button. Also, don't forget to click on the like button if you enjoy and appreciate the effort that goes into making these videos. Now, without further ado, let's get right into it. All right, so the first thing that I want to quickly cover is the small trader put call premium. Now, this is a chart that goes back to around 2000 here, and it highlights the put call premium that small traders are willing to pay. When it's very low, it means a lot of traders are betting on upside. A lot of traders are willing to pay a premium for calls on the market. When it's elevated, it means traders are willing to pay more for puts relative to calls. So it's a good sentiment indicator. It's a good indicator of how much fear is in the market. And that's one of the big principles that we have. We want to stay away from what everybody's doing. And so when we see the put call ratio be extremely low or extremely elevated, it tells us we want to be looking in the opposite direction. Now let's zoom in on this chart here and take a look at what's been happening throughout 2022. And we've had this small trader put call premium spike, of course, ever since the all-time high. But what's interesting is that we've spiked to incredibly elevated levels. The small trader put call premium is higher than it was at the height of the pandemic. It's higher than it was in 2018, where we also had a 20% correction. It's higher than it was in 2011 right here, where you had a 22% correction off the recent high. It's at the same levels where we were near the bottom of the great financial crisis. Now, that doesn't mean we're in exactly the same macro posture as we were here. It's very different to what's going on there. But this gives you a measure of how much fear is in the market. And it's definitely justified, right? We've got a Federal Reserve that's tightening very aggressively. We've got inflation that's through the roof, a huge amount of concern over a recession. And so you can understand why the fear is rampant here. But on the other hand, this is a great chart that should keep your mind open to seeing the market actually perform a lot better than what most people are expecting. Because when the fear is so intense, when fear is so elevated like this, as it was at the bottom of the 2008 bear market, at the bottom of the 2002 bear market here, where it spiked to similar levels that we're seeing now, it tells you a lot of the concerns have been priced in. Everyone's aware, and so everyone is flipping bearish and buying puts. And that can mark some pretty big market bottoms. And you can see that I've back-tested this reading here that we had back in June here. And there's really been 3 periods where we saw this type of rise in the small trader put call premium. Once near the bottom of the COVID-19 pandemic, once near the bottom of the great financial crisis, and many times near the bottom of the 2000 to 2002 bear market. So again, of course, we're in a very different situation to where we were here in 2002 or in 2008, where these periods were definitely the beginning of a brand new economic cycle, right? Where unemployment was incredibly elevated and it was coming down, telling you you had a large runway ahead. Same thing in 2002. Unemployment was really high and you had a lot of runway for economic data to improve ahead of that. Whereas right now, you've got unemployment near historic lows. And so we are much later in the economic cycle to these two periods. But this chart does clearly show that a lot of people are betting on the downside right now. There's a huge amount of pessimism, and so perhaps it's time to look the other way. Now, jumping a little bit more into the macro, this is a very interesting chart that I wanted to show you. And it's the initial jobless claims against the real spending on goods. So the spending on goods minus the consumer price index, it's turned negative in March 2022 and in April 2022. It's in negative territory. Now, what's interesting about this is that if we zoom out, this has historically always led to a recession. In December 2007, it turned negative. It led to a recession. Same thing in March 2001. As soon as it turned negative, it turned into a recession. If we zoom out further, every time it turns negative, you have a recession. So that could very well be the case today, and this is partly what's been driving this big aggressive move down in the market throughout 2022 is this collapse in consumer goods spending in real terms that's increasing recession fears. And so that does typically lead to a contraction in GDP, slower economic growth. However, on the flip side of that argument, if you take a look at real goods spending against the job market, so initial jobless claims, you'll see the situation is incredibly different. We've seen a collapse in real spending on goods, but that's been correlated to initial jobless claims moving down and the job market improving incredibly quickly. And you can see in each episode where that black line, so real spending on goods, was collapsing, you had the unemployment rate rise. Same thing again here. Black line moving down, unemployment moving down in 2002. Same thing again in 1990. Black line moving down, unemployment moving up. Black line moving down, unemployment moving up. So to us, the way we are seeing this right now is that typically a move down in goods spending is triggered by underlying economic weakness, especially in the job market, that can be seen by rising unemployment. Here we're seeing a big weakness in real spending on goods, but it's not being caused by a rising unemployment rate. So this is telling us that real goods spending has rebalanced because it was so elevated during the pandemic. It's been rebalancing and going into negative territory, but it's not been caused by people losing their jobs, which is the typical dynamic that you see when you see a decline in goods spending. Here, the unemployment, here, the job market is still strong. So could we be in a technical recession? Absolutely. Where GDP contracts? Absolutely. But what happens when that rebalancing is over, when that black line comes back up? Could that potentially mean we get a second boom in the economy before we really reach the end of the economic cycle? That's a possibility. This chart here should definitely raise some questions regarding that. Now, one of the most important charts that I'm looking at for the short-term price action of the S&P 500 is the VIX, the volatility index of the S&P 500. Now, we talked about this in the last video, but this gives you a tremendous insight regarding the risk reward of entering long on the S&P 500. You've had the VIX bounce up and down throughout this period, and all of these bottoms in the VIX have corresponded to tops on the S&P 500. And you can see that very clearly here. And again, another top on the S&P. Whereas the tops on the VIX have been tremendous buying opportunities. Now, of course, we'll see if that proves to be the case and we see a sizable rally in the months ahead, heading into the end of 2022. If that does prove to be the case, these will have been major buying opportunities for the S&P 500 to take advantage of the next run. Now on June 16th here, we posted a premium episode on the tactical strategy that we have over the next few months for stocks. And we highlighted this extreme low reading in the market breadth on the S&P 500. The percentage of stocks above their 50-day moving average was collapsing here. This was June 16th here, same level as it was at the very bottom of the COVID-19 crisis and in the height of the panic in 2008. So huge oversold reading. Now in hindsight, you look at June 16th, which was right here, the market quickly rallied 8% off the low. Now it retraced some of that throughout the week, and it could still continue to retrace more, but it's just to show you the power of using these indicators to give you the best risk reward, especially if you're betting on a big move to the upside. That can be a rapid 30% move off the low in a big counter trend rally. Even if you do see some more volatility in the coming days, which is completely possible, especially if you see one last capitulation with the VIX spiking up to the 46 to 50 range. That's a potential scenario. But even in that case, the buy the dip entry here will still prove to be incredibly successful when the market does recover. That's the goal we're really trying to accomplish with these short-term tactical updates. We make frequent updates on the market using various indicators to analyze the risk reward in the market. We do that through these short-term articles and through videos that highlight our strategy and the important developments. Now, if we take a look at the risk reward today and we take a look at the VIX, it's a lot more of a mixed picture than it was a few days ago. Here, the VIX is still coiling. Here, it doesn't know where it wants to go. If we break out of this consolidation, we'll see one final capitulation move down. We're not at any type of resistance. We're not at any type of support either. So for the short-term technical picture, just looking at the VIX here, it's a mixed outlook here. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.